And where are you going? What do you want?
Hello and welcome to Trust and Estates Weekly. I'm your host, Kevin Bemmel, and I'm here every Monday at 10 a.m. Pacific time to talk about estate planning and trust and probate administration, primarily from the standpoint of people like myself who do this professionally, but also to help those of you who are going through your own estate planning process or trying to get more familiar with it in anticipation of doing so, or perhaps you've been appointed as the executor of an estate and you don't know what to do. So certainly here to help you as well. So today I'm going to be talking about a situation where an estate does not have sufficient liquidity, or perhaps any liquidity, with which to administrate it. So, while technically this could happen in a trust, because of the ongoing nature of the trust and the typically much broader authority that a trustee has, uh, as compared to the personal representative for an estate, as well as, shoot, my thought just went away. Um, as well as the fact that with a trust, again, generally speaking, the court does not have cognizance over what a trustee or the trustees do, right? So dealing with the issue of illiquidity is easier in a trust in most cases. But in a probate, where the job of the personal representative, being an executor or an administrator, a professional fiduciary like me, their job is to collect the assets, pay the debts, and distribute the remaining the remaining assets of the estate. So if there is no liquidity in the estate, no cash in the estate, or if it's very limited, so this can make the personal representative's job much more difficult. Now, it can be something as simple as paying the funeral expenses for the decedent, which oftentimes, even if there's a life insurance policy, that policy will not pay off in time to pay for funeral expenses. Now, there are some funeral homes that will essentially, agree to wait for their money in one way or another. Most will not. Minimally, somebody's going to have to come up with at least a credit card, right, to pay for the burial if there's a service or whatever. Okay, typically it's going to be the family members, the surviving family members who do that. Rarely will a personal representative who's not related to the decedent agree to front those kind of expenses. And so it could be something as simple as that. It could be that there are debts that have to be paid, there are mortgage payments that have to be made, etc. And it could be that the estate is large enough that estate taxes have to be paid. So if it's as you know, in the recent tax legislation that was passed recently, the estate tax exemption was set at about $15 million. Okay, so that's going to exempt most estates from estate taxes. But if you've got a $20 million estate or larger, or even a $16 million estate, you are going to owe some estate taxes, and the estate tax rate is high. It's 40%. Now it starts out lower. It's a graduated tax, but it ramps up to 40% pretty quickly. So for planning purposes, if you've got a 16, let's say you've got a $20 million estate, so subtract $15 million from that, you've got $5 million. The estate is going to owe around $2 million in estate taxes. Now, there are adjustments that are made to that. The costs of administrating the estate are deducted. If there are debts on real estate, so that may be deducted from the gross value of the estate, right? So I'm not giving you accounting advice as the the ticker scrolling on the bottom of the screen indicates, but I'm just giving you an idea of what the estate tax burden could potentially be. And if you've got an estate worth $20 million, okay, it's likely that it has at least some, if not a lot, of illiquid assets. So those assets could be real estate, they could be a closely held business, it could be collectibles, art, cars. Okay, and you say, well, what kind of car adds up to $20 million? Well, there are Ferraris that I was listening to a podcast a week or two ago, some special edition Ferrari. I think it's selling for, I think they said something like $10 million. Okay. And because they're only making a couple hundred of them, it's unlikely that the price is going to decline once they're sold. They will probably appreciate over time. So, if an estate owns one of those cars, right there, you've got $10+ million of value. And a car, a collectible like that is an illiquid asset, right? Because it can't be readily turned into cash the way publicly traded securities can be, or bonds can be, or for that matter, cash, right? The estate has a bunch of cash in it for some reason. So there's also court costs. There are accounting fees. Okay, so unlike the personal representative, who, especially in a state like California, so typically I get paid what are called statutory fees, which means the fees are set by the probate code, and I'm not eligible to collect those fees until the probate closes. Now, I can apply not just me, any personal representative can apply for interim fees. Okay. But if there is not cash to pay them, the court may very well ask, well, okay, you're applying for interim fees. There's no cash in the estate. How are you planning to pay these fees? Right. And if paying the fees, interim fees, to the personal representative would make it more difficult to operate the estate, the court may very well not allow extraordinary fees because they would view it as a breach of duty on the part of the personal representative. Okay, so the personal representative and usually his attorney is also getting what are called statutory fees, again, paid when the probate closes. Okay, but other professionals typically want to be paid up front. That includes the probate referee, interestingly enough, who's paid by the court. That includes the accountants. It includes appraisers. Okay, so a probate referee, as I've talked about in other shows, is essentially an appraiser appointed by the court. However, the IRS, generally speaking, will not recognize the professional qualifications of a probate referee merely because they're a probate referee. Okay, so if you've got an estate that has a lot of real estate in it, for example, and the probate referee is not properly credentialed, you could end up paying for a probate referee and then having to pay for an appraiser as well. And that appraiser is going to want his fees, if not up front, which many appraisers do at the time of or just prior to delivery of those reports. Okay, and there could be lots of other needs for liquidity. There could be insurance that needs to be paid for on property, on a collection. If there's if there's a collection, let's say there's a collection of cars, it would be a breach of fiduciary duty not to maintain insurance on those cars. what would happen to the inheritance of the beneficiaries if the cars were stolen and couldn't be recovered, or they were recovered but they were damaged, right? And there were no insurance. They were not properly insured. So all of these various costs require payment while the estate is making its way through probate, and therefore they necessitate liquidity. So uh, there are several options that a personal representative can consider. There are two somewhat esoteric Internal Revenue Code sections to deal with this. I'm going to talk about them I'm going to talk about them later. So I'm going to talk about some of the more straightforward ones first, okay, and explain why these may not be good options, and then you'll be able to better see why the Internal Revenue Code has these other options. Okay, so let's talk about, first of all, an estate that has a lot of real estate in it. Now, if that real estate is the decedent's primary residence, okay, it probably wasn't rented out, okay, and if the real estate also includes a second home, or so then maybe that wasn't rented out either. But if it includes some income producing property, okay, so then that property is producing some income. Hopefully there's income over and above expenses, okay, and so then the money that otherwise would have gone to the decedent now comes to the estate, and that could provide some liquidity for the estate. If the estate has houses, okay, and for whatever reason, the personal representative thinks that the houses are not going to be sold, so maybe there's only one heir. The heir would like to retain the house, and so the personal representative has decided to do that. So then maybe the house or houses can be rented out, and that will generate some income, some net income over and above the expenses of owning the houses. That's a possibility. Although in many places the rental on a house is not larger than the property taxes, insurance, and maintenance costs, and mortgage payment if there is one, and so that may not be feasible. Now, the estate may also own a property in which a closely held business operates, and maybe for various reasons, the estate or I'm sorry, not the estate, the decedent was not charging rent to the business for being in that space, okay? If the business is going to be ongoing, so then it may be time to negotiate a rental agreement between the business and the property in which it's located. And again, that could generate some income to the estate and provide some liquidity. So one of the first things I would look at is, again, generate what property does the estate own that can be rented out, that would generate some net income and provide some cash to the estate for other expenses. So that's one way of handling things. Okay, and it's a pretty obvious one. The next most obvious one is to sell some assets. Okay, so again, going back to that example where there's a house and there's a primary residence, a secondary residence, maybe some income property, or maybe there's a property in which a business is operating. Okay, so maybe it makes sense to sell the second home. Okay, and then the proceeds from that sale can provide liquidity to the estate for the payment of various expenses. Okay, that might be one thing to do. Now, the issue with selling property is the estate doesn't want to have to, conduct a fire sale, so to speak. Okay, and oftentimes people think because an estate is selling property, they're going to be able to buy it at a below market price or a fire sale price. Okay, that is generally not the case, at least in my experience. I know I I don't play that way, I guess is the best way to put it, right? And there are a lot of people who get, there are a lot of potential buyers who get very exercised about that. Especially, I've got one estate in particular where the buyer was supposedly a very close friend of the decedent, and he seems to think that that entitles him to buy properties from the estate at significantly below market value. And I explained to him from the outset, it's not gonna work that way. Okay, if you're such a good, if you were such a close friend of the decedent, you shouldn't want to, in essence, cheat his heir. It's a rather ludicrous situation. Okay, but they come out of the walls, if you know what I mean. And so, if as the personal representative, you decide that it's in the best interest of the estate to sell some property, okay, so then the conditions hopefully will be such that uh, um, you can get market value for the property, and you don't have to take a big discount. So I know here in Los Angeles, I'm delaying some property sales. We've had some difficulties here if you've been following the news, and a lot of real estate activity basically stopped. Okay, and rather than sell into a very slow market, I've decided just to put a hold on property sales, and let the market sort of reactivate and then go back in order to get market prices for the assets of the various states where I'm the personal representative. Okay, so all of these are issues that the personal representative needs to consider. Okay. Now, the other thing about, in fact, both with renting out property and with selling assets, is depending on the extent of the personal representative's authority, they may require court confirmation or court approval. Certainly, if you're entering into a long-term lease, okay, that may require court approval. Selling a property, if the personal representative doesn't have full authority, would require court approval. Okay, so all of this has to be factored in, and if it's a small property that's only going to generate a little bit of money, how much of that money, if court confirmation is necessary. So if court confirmation is necessary, is the cost of going to court to confirm the sale going to be a significant percentage of the value of the property? Now, here in California, that sounds ludicrous because the idea of a property not having much value seems so foreign. But in other states where property values are much lower, okay, it may be, you could have costs of sales of several $1,000s, and maybe you're selling a property that's only worth $20,000 or $30,000. I mean, and you're going to lose, a third, a quarter, a half of the value of the property by going to court to confirm the sale. So, in that case, it may not make sense to sell those particular assets, even though they may have the least utility to the estate. So all of these factors need to be weighed in order to determine whether renting out a property or or selling a property is the right way to create liquidity. Okay, let's take a break. When life brings unexpected changes, managing inherited property shouldn't add to your stress. Magnum Properties specializes in probate and trust real estate management. We handle the complexities while you focus on what matters most. From property maintenance to tenant relations, from legal compliance to maximizing value, we're your trusted partner through every step. Magnum Properties, Inc., turning property challenges into peace of mind. Call us today at 213-264-4396 or visit magnumprops.com. So this is Trust and Estates Weekly. I'm your host, Kevin Bemmel, and I'm talking about what to do when an estate doesn't have liquidity, and so it's challenged to pay the costs of administration and the cost of maintaining assets, etc. So I mentioned before the break, I mentioned two ways. One is to rent out real estate if the estate has some. The other is to consider selling some real estate. So those are two of the most common options. Another option is to get a short-term loan against the assets of the estate. Now, this is more difficult. A lot of lenders don't want to have loans on property going through probate. So, one in particular, U.S. Bank, I can tell you I will never do business with them again because of how they dealt with one particular estate that I administrated. They when the person when the decedent died, they called a loan on a property, and they were just absolutely unscrupulous in how they handled the situation. So, for my part, I had a banking relationship with them that I am in the process of terminating as a result. But it highlights that so-called conventional lenders, generally speaking, will not lend on properties in probate, and will seek to get out of those loans if they think it's to their best advantage, and they will shed crocodile tears for their borrower having died, basically. So there are, though, specialty lenders out there who lend on properties in probate. Generally speaking, they're short-term loans. The rates can be pretty high. So if you're familiar with hard money loans in the real estate arena, they'd be more along the lines of hard money loans. Okay. People will sometimes equate hard money loans to loan sharking. It's typically not quite that bad, but the rates are, could easily be 50% higher than, a regular loan on a similar type of property. Okay. And again, they will typically be fairly short term. Okay. Now, aside from these private lenders, the beneficiaries of an estate, they may also be a source to borrow funds, okay, especially if it means that they're going to be able to retain certain assets that otherwise would have to be sold in order for the estate to have proper liquidity. Okay, and by the way, there are lenders out there who specialize in advancing funds to beneficiaries. Okay, and so even if the beneficiaries don't have any cash of their own to lend, it may make sense for them to get an advance on their inheritance, turn around and loan that money to the estate on an interest-bearing basis. That could potentially be a solution to an estate's illiquidity challenges. Okay, so again, just like with any loan, various assets of the estate would be the collateral. It could be real estate, it could be a business, it could be other assets. Okay, and so this could all be negotiated and worked out. But even if it's a loan from the beneficiaries, that could it could require court approval. Okay, so I wouldn't undertake such a transaction without proper legal guidance. and if necessary, proper direction from the probate court. Okay, but borrowing money for so the estate has the cash it needs to operate. That's another option. Okay, another option would be distributing certain assets prior to the estate closing in order to transfer the obligation in essence, the cash needs of those properties to one or more of the heirs. Okay, so let's say you've got a house, okay, and the house. Let's take an easy case where the estate is exempt from estate taxes. So let's say it's a $10 million estate. Okay, so estate tax exemption, $15 million. There's no estate tax due. Don't have to deal with the IRS, at least with respect to that. Okay, and so it may be that rather than the estate bearing the cost of paying a mortgage and property taxes and insurance, I'm sorry, let me back up and let's take another, let's make it simple again. Let's say there's just one heir as well. Okay, so it's a $10 million estate. There's one heir. He's getting all of the proceeds of the probate. Okay, and let's say there's a house in the estate. There's a mortgage on it. It has so perhaps the personal representative would petition for early distribution of the house, so it goes to the heir, and now the heir has the responsibility for paying for the mortgage and paying the property taxes and paying the maintenance. Okay, and maybe he wants to move into the house. Okay, maybe it was his childhood home. He loves the house. He wants to raise his family there. Okay, and so they move in and they take it over, and hey, that takes a cash financial burden off of the shoulders of the estate. It gets the house to the heir who wants it anyway. Okay, and it's kind of a win-win situation. Now, even with full authority, okay, the early distribution of an asset may require court approval. Okay, but it may make sense to do that if it's a couple of $1,000s to petition the court, and if the petition really makes sense. Okay, so there you go. I mean, here in California, right, median home price over $800,000, $850,000, I think it is, or something like that. So you're able to distribute a valuable asset with maybe a few $1,000s in court fees. And when you think about it, in California, an $800,000 home, the property taxes alone are going to be $9,000 to $10,000 a year. Insurance has gone way up here in California. It's going to be several thousand more dollars a year. And if there's a mortgage on it, that mortgage could easily have a monthly payment of several $1,000s, right? So it may be better to just put it in the hands of the heir, let him go ahead and live in the house and enjoy it, and take that burden off the estate. So the preliminary distribution of assets may be a way of dealing with illiquidity as well. And so that's another option. It's kind of like selling an asset, but you're not selling it now. You're getting it into the hands of the person who would otherwise inherit it. Okay, and then so those are the sort of straightforward strategies. There are others, but those are the more straightforward strategies. Now, I mentioned at the beginning of the show, I'm going to talk about two more sort of esoteric strategies for dealing with an illiquid estate. And these are creatures of the Internal Revenue Code. And so they are very complex. There's lots of requirements. I'm not going to get into all of the details. If you think this is something that you may want to use, you need to get a qualified accountant to help you navigate these issues, or maybe even a tax attorney. Okay. And when I say a qualified accountant, I don't mean someone who, helps you with your tax preparation. While that's perfectly, good work, someone at that level is unlikely to know enough about the details of these two potential methods to be able to properly execute them with any sense of sureness that they're being done correctly. So I'm talking about IRC section 61, 66, and 303. Okay, both of these deal with a situation where one of the assets of the estate is a closely held business. Okay, so the term closely held refers to a business whose owner with an ownership that's not traded on public markets. Okay, so AT&T, Meta, Tesla, Alphabet. These are all companies that have been in the news of late, and they're all traded publicly. These are publicly traded companies. They have thousands, tens of thousands, maybe hundreds of thousands of shareholders. Okay. A closely held business, by contrast, is not publicly traded. It's owned, generally speaking, by a relatively small number of owners, or even just one owner. Okay. The ownership interests do not trade on in any kind of public forum. Okay. Hence the name closely held. Now, the thing about a closely held business is it's very illiquid, meaning it's not easy to sell them. Whereas selling, 100 shares of Alphabet, you just call up a broker and say, sell the shares, and they're sold at whatever the prevailing price is that day. If an estate holds an interest in a closely held business, you can call up a broker, but they're going to say, sorry, can't help you. At least not a stockbroker or a financial advisor. Okay. Now, there are business brokers, and they specialize in selling closely held businesses. Okay. But even for them to sell a partial interest in a business can be difficult. And it's probably going to be sold at a substantial discount to the overall value of the business. Okay. And it's because of that the IRS, or really Congress, came up with these two Internal Revenue Code sections that basically are helping an estate that owns part of or all of a closely held business deal with the potential tax consequences, estate tax consequences, so that the business won't necessarily have to be sold in order to pay the estate taxes. Okay. So in other words, it's there to help the continuity of ownership of closely held businesses, among them family businesses. Okay. A lot of family businesses are closely held because they're owned by family members with the intent that they're going to be passed down, generation to generation. Okay, so let's look first at Internal Revenue Code section 6166. Okay, so this applies in an estate that owns a closely held business, or part of a closely held business, where that interest exceeds 35% of the adjusted gross value of the estate. Okay, now, adjusted gross value is a term defined in the IRC, the Internal Revenue Code. Okay, and that, starting right there, you can see why an accountant is necessary, because they have to know how to calculate the adjusted gross value of the estate. Okay, and then the value of the business is going to have to be determined, or the value of the interest in the business is going to have to be determined. And then if it's 35%, if it's over 35%, then the use of section 6166 may work as a way to deal with the illiquidity of an estate. Okay, what does it do? It allows the personal representative of an estate to defer estate tax payments attributable to the value of the business for up to 10 years. Okay, so it essentially creates an installment plan for paying the portion of estate taxes that are due to the value of the business. Okay, now only the personal representative can make this election. So let's say you have a situation where there are three owners of the business, okay? The estate and two surviving owners. The surviving owners have no authority to elect a 6166. Only the personal representative does on behalf of the estate. Okay, so now that doesn't prevent the co-owners from suggesting that that's what the personal representative should do, and in fact, if they think that is the case, they should discuss it with him and all cooperate together. Okay, the idea is to avoid a fire sale of the business or the sale of an interest in the business to some unknown party now that makes it difficult, if not impossible, to operate the business on a going concern. Okay, so let's see. All right, so let's first. Now there are several tests as to whether 6166 can be elected. First of all, the decedent has to have owned an interest in a closely held active trade or business. Okay, that's number one. It was he either had to have been a sole proprietor, meaning the sole owner of the business. In this case, sole proprietor, I don't mean that from a legal standpoint, in the sense that there was no separate entity. Okay, the business could have been maybe conducted as an LLC, but in this instance, if the decedent was the sole member of the LLC, in effect, it was kind of like a sole proprietor. He was a sole proprietor, as opposed to the business being a sole proprietorship. He was the sole owner of the business. Okay, so the decedent either has to be the sole owner of the business, or if the business was a partnership, the decedent has to have owned 20% or more of the capital interest in the partnership, or it needed to be a partnership with 45 or fewer partners. Okay, or if it was a corporation, the decedent had to own 20% or more of the voting stock, or again, had fewer than 45 or fewer shareholders. Okay, so there has to the interest that the estate has in the business has to be significant. If an estate has a 5%, or let me use a different example. If the estate has a 2% interest in a business, let's say it owns 2% of the voting stock, okay, that's not going to meet the 20% threshold, nor is it may meet the 45 or fewer shareholders, but at 2%, that seems to imply there's a lot of shareholders. Okay, so it may not meet the shareholders at all, and so then 6166 couldn't be used. But then again, that 2% interest in the business, it may not be a very large asset, and so the sale of that interest to other shareholders or to the business itself wouldn't necessarily result in a huge discount per se. Now, I'm going to take a moment to digress, and that is, and I did a show on this in the last, I think couple of weeks. This discussion should highlight why businesses need to have succession plans. Closely held businesses need to have succession plans. Okay, among the provisions that should be considered is what will happen to the ownership of a deceased owner? Okay, is there going to be some sort of buyout mechanism as part of the estate planning for all of the owners, and as part of the business continuity planning, right? Does the business want to end up in being partly owned by, let's say, the decedent's spouse or the decedent's children or other relatives? Maybe not. Maybe there needs to be a mechanism by which, when one of the co-owners dies, um, the deceased owner's interest is purchased by the company or by the other owners, and there's a set formula that's been agreed to, in which case all the personal representative would need to do is see to it that process is handled correctly. And now, to the extent that the estate was illiquid, and there's this provision in the business continuity planning, that could also be a solution, or at least a partial solution, to the lack of cash in the estate. Okay, but in the absence of that, 6166 may be a good way to go. Okay, so generally speaking, the decedent has to own 20% or more of the business, or if it's a partnership or corporation, 45 or fewer partners or shareholders. Okay, the business interest must comprise more than 35, or at least 35% of the adjusted gross value of the estate. Okay, and the election has to be timely made. Generally, it's an election made on the Form 706. That's the estate tax return. And there are extensions available for filing the estate tax return, just like with a personal tax return, or for that matter, business tax return. Okay, but that election does have to be made. And again, this is something, I would certainly seek accounting guidance on, to make sure that it was done correctly. Okay, and there aren't problems going forward. Okay, now the deferral of the payment of the portion of estate taxes attributable to the business isn't interest free. So the IRS will charge interest on that. Okay, your accountant can tell you what that currently would be, but there will be interest payments due. But that may be better than selling the interest at a fire sale. Okay, so let's just take a real simple example. Actually, before I do that, let's take a quick break. Probate and Trust TV, your curated source for the most useful and insightful content on estate planning and trust and probate administration, featuring standout professionals like Bill Gross, Paul Brabelet, James Cunningham, and yours truly. Whether you're a lawyer, accountant, real estate professional, or working on your own succession plan, this channel helps you quickly find the clearest, most practical content YouTube has to offer. Subscribe now to Probate and Trust TV. Spend more time learning, less time searching. Okay, we're back at Trust and Estates Weekly. We're talking about what to do when an estate is illiquid. And I was talking about using Internal Revenue Code Section 6166 to defer payment of taxes on an interest in a closely held business. That an estate could potentially qualify for that if it owns 20% or more of a business, and if the value of that interest in the business is 35% or more of the adjusted gross value of the estate. Okay, so let's take a very simplified example, okay, just to give you a sense of how the numbers might work out. Okay, so let's say that a decedent owns a manufacturing company, and it's valued at $10 million. and the total adjusted gross value of the estate is $25 million. Okay, so a couple things right off. One is at $25 million adjusted gross value, the estate is taxable because the estate tax exemption is $15 million. Okay, so there's going to be approximately a $10 million $10 million, I should say, of the value of the estate is subject to estate taxes. Okay. In this case, also, the value of the business at $10 million against a $25 million adjusted gross value for the estate makes up 40% of the value of the estate. So it meets that 35% threshold. The owner is the sole owner. Okay, so that complies with the minimum 20% ownership of a business by the decedent. Okay, so both of those are met. So it appears, again, in this simplified example, that section 60, that the personal representative could elect to take advantage of section 6166. Okay, so let's say he makes that election. Now, with $10 million in adjusted gross estate value over and above the $15 million estate tax exemption, right? That means that there's $10 million of tax that's taxable at 40%, meaning roughly there's a $4 million estate tax bill. Okay. Now, since the business makes up 40% of the adjusted gross value of the estate, 40% of that $4 million could potentially be deferred. Okay. So, in other words, $1.6 million of the $4 million could be deferred. Now, you can see right away then that, let's say the estate is short on cash. Well, by making a 6166 election, the cash needed to pay estate taxes has gone from $4 million to $2.4 million. Okay, the other 1.6 being deferred over as much as the next 10 years. Okay, and so instead of having to pay $1.6 million essentially up front, the estate could pay $160,000 a year plus interest, right? Which is a lot lower cash outlay. Okay. Okay, and so if a 6166 election is made, so then, and it's essentially at the option of the personal representative, whether to defer the payments over 10 years, they could do it over 5 years, 8 years, whatever the personal representative thinks is right. Obviously, there's a trade-off between a longer time period and larger overall interest payments. Okay, there's also greater interest rate risk because the IRS changes the interest rate it charges on these kinds of installment plans periodically. Okay, so although the estate could elect to extend it over 10 years, it may decide not to for various reasons. Okay, and that may have to do with, in this case, it's there's only one owner, but especially if there's more than one owner, right? So then the timing of those payments may depend in part on distributions of profit from the business. Okay, and so that may need to be worked out in conjunction with the people who are going to continue to run the business. Okay, now the use of 6166 could impact when the probate closes. I say could because it depends. All of these things have to be worked out. Okay, but maybe there'll be some preliminary or early distribution of other assets while this is worked out. If for whatever reason the probate can't close while the 6166 deferred tax payment agreement is being worked on, or being paid off, I should say. So all of these needs to be aware. But you can see it's very complex. Okay, but it can provide some significant liquidity relief to an estate. Okay, so that's 6166. Okay, all right. Now, the other one I mentioned is Internal Revenue Code, IRC Section 303. Okay, and this applies when a decedent owns shares in one or more closely held corporations. Okay, so now this is more specific. It's not any kind of business, it's specifically a corporation. Okay, now the strategy is that the corporation can redeem shares to provide for liquidity for taxes and expenses without without those disbursements being subject to dividend tax treatment. Okay, so again, this is a very sophisticated maneuver. It needs to be the personal representative has to be the one who elects to do this. Okay, to be candid, I've never done a Section 303, so I can only speak to you about it from an academic standpoint. But were I to do something like this, again, I would have my accountant involved. I would probably have I might have a tax attorney involved, depending on the dollars at stake, and I would definitely be working this out in conjunction with the other owners of the business. Okay, so what Section 303 allows is for essentially a buyback of the decedent's stock without triggering income tax on the redemption. So it treats it as a sale, but not as a dividend. And this can be beneficial because if it's treated as a sale, it might be subject to capital gains taxation as opposed to taxation as ordinary income, the way it would be if it were taxed as like dividends. Okay, it also could mean that the business would not have to be sold. Okay, because let's say that you've got a majority stockholder, right? So it may be that if that closely held stock needs to be sold, in the end, the entire company would have to be sold. Okay, or the minority owners may end up with a majority owner. Who the heck knows who this guy is, and that kind of stuff, which could put them in what they would feel to be a very bad situation. Okay, so this is a way of dealing with business continuity in the absence of continuity planning. Okay, so I go back to what I said a little while ago about you can see that these special tax code provisions are there to help businesses that have not planned properly. That's really the bottom line. Okay, so just some eligibility requirements. I'm not going to get as deep into 303 as I did with 6166, but they have to be closely held corporations, publicly held. Stock and publicly traded companies does not qualify for Section 303 treatment. Okay, and they have to be domestic corporations, meaning U.S.-based corporations. Okay, the value of the decedent's stock has to be 35% or more of the value of the decedent's adjusted gross estate, or 50% or more of the taxable estate. Okay, now you saw in the previous example, we said the adjusted gross value of the estate was 25 million, but the taxable estate was only 10 million. Okay, so there is a big difference potentially because of the $15 million exemption. And so there's two different tests here that can be used to see if an estate qualifies for Section 303 treatment. Okay. Now, the redemption, there is a limit on the redemption of the stock, and that is it must be no more than the sum of federal and state estate taxes, or so-called death taxes, plus the financial and administrative expenses. Okay, so if there are other expenses to the estate, maybe there's maintenance of other properties and things like that. Okay. Additional redemptions cannot be made to cover those costs. This is only really for a way of seeing to it that the need to pay estate taxes doesn't require a negative event for the business. But other expenses to the estate, this won't provide liquidity for that. Now, of course, money is fungible. So the fact that you can get liquidity to pay estate taxes, maybe the estate has other liquidity, it can use those other funds for maintaining other assets. Okay, so that's the fungibility of money, of cash. Okay, so that's basically how 303 works. Again, it's a complex strategy that requires a knowledgeable accountant, an experienced accountant, an accountant who's done this before, okay, and maybe even legal advice. Okay, so those are some of the ways of dealing with illiquidity in an estate. The list is not exhaustive. There are other things that you can do, but those are the most common and perhaps two of the more creative options. So I thank you very much for joining me today, especially my live viewers. If you liked the show or you found it interesting, please pass it along to a colleague or family member. I'd really appreciate that. And, of course, always looking to grow my audience and help more people. Tomorrow at 10 a.m. Pacific time is my show, Business Lessons from the Military. On Wednesday at 10 a.m. Pacific time is my show, People Making Money. That's the schedule for the rest of the week. So once again, thank you very much for joining me. If you have any thoughts, comments, criticisms, all my social media links will be in the show notes when the show posts on YouTube. Always happy to hear from you. And again, thanking you so much for joining me. Wishing you a wonderful rest of the day. Signing off as I always do. Marie, darling, you are my belle. Courage at all times, my friends.